Welcome. In this explainer, we are going to deconstruct the investment philosophy of the legendary Vanguard founder Jack Bogle. Specifically, we will be examining his celebrated yet often controversial stance on why you might not actually need international stocks in your portfolio. So, let's start with a fundamental question. Is global diversification really an iron law of investing? For decades, we've been told that it's an essential principle for building a sound portfolio. Jack Bogle, however, presented a compelling, data-driven challenge to that very idea. Now, to truly appreciate Bogle's contrarian position, we first need to understand the conventional wisdom, the financial doctrine that he so famously questioned. The orthodox view, which is taught in just about every finance class, is pretty straightforward. It says that spreading your investments across different countries and economic regions is a fundamental principle for building a resilient portfolio, one designed to insulate you from the localized shocks that can hit any single market. And it's against this established doctrine that Jack Bogle stood. He consistently challenged this view, with a philosophy that was rooted in simplicity and a very sharp focus on empirical evidence. At its heart, Bogle's argument was rooted in the unparalleled strength and stability of the U.S. economy. He contended that for the average retail investor, a single, broad U.S. index fund already offered all the diversification and growth potential that they would need. This single quote really gets to the very heart of his logic. Bogle argued that the largest U.S. companies are, for all intents and purposes, already global enterprises. This means you're getting significant international exposure without ever having to leave the domestic market. Think about these titans of the S&P 500. Their products are sold, their services are used, and their revenues are generated in nearly every country on Earth. For Bogle, owning these companies through a simple index fund meant that you were already participating in global growth. And the data powerfully supports this perspective. You see, a huge portion of S&P 500 revenues, often estimated somewhere between 30 and 50%, is generated outside of the United States. This provides a built-in layer of global exposure right from the start. But Bogle's argument wasn't just about the benefits of a U.S. focus. It was also very much about the specific risks he identified with direct international investing. He framed these as 4 distinct hurdles for investors to overcome. Bogle highlighted 4 primary hurdles. The first is currency risk, where a strong U.S. dollar can directly eat into your returns from foreign stocks. Second is geopolitical instability, because international markets can and often do carry a higher degree of political and economic uncertainty. Third, you have higher costs, since international funds frequently come with greater expense ratios. And the final point, which is perhaps the most critical, is high correlation. And this point about high correlation is absolutely crucial. Bogle argued that in a global crisis, markets tend to become highly correlated. They all fall together. So if your international stocks fail to provide that buffer precisely when you need it most, their main purpose in your portfolio is fundamentally undermined. Now, you might be thinking Bogle was completely rigid on this. But despite his staunch U.S.-centric view, he wasn't entirely dogmatic. For investors who still felt they wanted international exposure, he offered a very clear and pragmatic compromise. And his compromise really came down to a single number, 20%. For those investors who felt compelled to add direct international exposure to their portfolios, Bogle suggested capping that allocation at a maximum of 20% of their total equities. And Bogle was very specific with his advice for this allocation. He insisted that investors should use broad, low-cost index funds, and that they should strictly avoid the higher costs and additional risks that come with picking individual foreign stocks or using actively managed international funds. So the question then is, where does this leave us as investors today? Let's try to distill Bogle's philosophy into its core lessons for building a modern portfolio. When you get right down to it, the debate really boils down to this. Bogle's case for a U.S. focus rests on simplicity, lower costs, and that built-in global reach of American companies. The counter-argument, on the other hand, champions the potential for higher growth in other markets and the classic benefit of reducing home country bias by capturing different economic cycles around the world. This leaves us all with a final, critical question that every investor needs to answer for themselves. Jack Bogle saw a strong U.S. focus as a prudent shield against unnecessary risk. The challenge for us today is to decide if that shield has now become a barrier, potentially blocking out major opportunities in our deeply interconnected global economy. If you found this breakdown of Bogle's thinking useful, please show your support by liking this explainer and subscribing to the Finbot Insights channel. We look forward to bringing you more clear, actionable analysis.